Welcome back to Market Pulse, where we decode the week's biggest financial stories. Emma Reynolds here, joined by Jack Carter. Today, we unravel a chilling forecast from hedge fund legend Paul Tudor Jones.
Hi Emma, thanks for having me. Jones' reputation as a market soothsayer precedes him. He called the 1987 Black Monday crash and is now warning of new market lows despite potential tariff reductions.
Exactly, Jack. Jones highlights how tariffs alongside Federal Reserve policy are a toxic mix. Even with Trump's China tariffs reduced from 145% to 50%, he predicts markets will suffer significantly.
Yes, and to think a 40% tariff cut is still the largest tax increase since the 1960s. It's a classic economic squeeze, but it's not just about percentages, it's about the macroeconomic ripple effect.
True, and Jones estimates a 2% to 3% dip in U.S. economic growth. He argues that without aggressive interest rate cuts, this could spiral into a bear market. Do you see merit in his analysis? Indeed, Emma, reduced growth rates are plausible under the increased tariff burden. Jones suggests economic pressures due to tariffs are akin to placing a weight on a fragile economy, a vivid analogy for potential strain.
That's a critical point. If consumer spending falters due to a slowdown, could we see a broader economic standoff reminiscent of prior recessions, though some argue consumer resilience is stronger today?
Well, history has shown that over-reliance on consumer spending is risky. For instance, the 2008 crisis revealed that underlying weaknesses eventually surface. Jones is highlighting possible overlooked vulnerabilities.
Absolutely, Jack. Yet there's a counterargument suggesting that corporate tax reforms and deregulation offer a buffer. Could these elements mitigate the recession risks Jones presents?
Interesting thought, Emma. While tax reforms can offer short-term relief, the issue is structural. Prolonged trade wars and monetary policy stall growth, a view supported by recent McKinsey reports predicting wider global impacts. Let's pivot to the Fed's role. Jones believes the Fed's hesitance to cut rates will compound market woes until detrimental levels are reached. The wait-and-see approach seems risky, doesn't it, Jack?
Certainly, Emma. The Fed's caution can seem prudent, yet Jones casts doubt on its timing strategy. A reactive stance often misses the mark, as seen in late responses during the 2001 and 2008 financial crises.
Yet, there's a school of thought advocating that premature cuts might ignite inflation without solving underlying trade issues. Is there a middle ground?
Possibly, but Jones argues for synchronizing fiscal and monetary policies. One hypothetical solution is the Fed cutting rates alongside strategic trade negotiations, a synergy not yet realized, according to IMF critiques.
So, forward-thinking involves proactive rate adjustments while addressing trade tensions comprehensively. A complex dance, perhaps, but essential to cushioning economic shocks, wouldn't you say? In navigating uncertainty, Emma, Jones advises diversification. This approach protects portfolios against sector-specific downturns, much like a multi-anchor strategy in turbulent waters.
Prudent diversification is a time-tested strategy. However, critics point to its limitations during systemic crises. What alternatives exist for investors seeking stability?
True, diversification alone isn't foolproof. Alternatives include defensive sectors like utilities and healthcare, or fixed-income securities. These can provide safe havens when traditional assets falter.
Indeed, and the current climate necessitates vigilance on policy developments. Whether tracking Fed signals or tariff talks, staying informed is key. How do you envision the economic landscape unfolding?
Emma, the market's direction hinges on policy clarity and consumer sentiment. If Jones' warnings catalyze swift policy responses, investors might see stabilization. Otherwise, brace for